is in progress. All right, on to other news now. Eskom is announcing its interim financial results at Megawatt Park. Let's go live to that briefing.
By a 15.06 tariff increase, which we were able to implement after prevailing in a number of high court cases. We were also able to further strengthen the balance sheet. Our gross debt, for that matter, our net interest-bearing debt overall decreased by some 15%. So we continue to bring our debt under control, and we were able to repay our capital to the tune of 24.4 billion. We're very grateful for government support, which played a key role in enabling us to reduce our debt to the tune of some 31.7 billion. Of course, generation did not have a good first half. We had to implement, sorry, can we just go back to the previous slide? Of course, generation didn't have a good first 6 months. We had to implement load shedding to the tune of 427 gigawatt hours. This is 5% less than in the comparable period the prior year, but still not something that we are pleased with, and something that is enjoying a lot of attention of our Chief Operating Officer, Jan Oberholzer, and the Managing Director of our Generation Division, Philip Dukashe. We had a very good performance from transmission and distribution, and then also were able to make good progress on our new build program. More on that in subsequent slides. From an environmental perspective, also improved performance, and then we were able to continue to reduce our headcount in a steady and responsible manner using natural attrition and voluntary severance packages as our major levers, so no forced retrenchments in accordance with the instructions of our shareholder. Legal separation, very important strategic imperative for the electricity supply industry in South Africa to enable greater confidence from private investors to invest particularly in generation. So that's a very important strategic enabler. We're making good progress on that, and we will give you more detail on that later on. We are forecasting a net loss of 9.1 billion for the end of the financial year. Caleb will unpack the reasons for that. But suffice it to say that we are going to be working very hard as a management team to address this forecast loss and see in what ways we can mitigate it and bring that number down to something that is more acceptable. Next slide. From a generation performance perspective, you can see there that our plant availability was at a very poor 65.27%, down from prior year. So more work needs to be done there. Part of the reason why this performance has declined is due to the increased maintenance that we have done. As a consequence, even though in gigawatt hours we implemented load shedding 5% less than in the prior year, in number of days during which we had to implement load shedding, it was 21 days instead of 19 days. I may just also add here and stress that one of our key cost drivers is coal cost, and we were able to contain our coal cost in rands per tonne to a 0.7% reduction compared to the prior year. If you adjust for inflation, that equates to about a 5% reduction in our rand cost per tonne for coal. And this breaks a trend over a number of years of double-digit increases in our cost of coal. So again, a very pleasing intervention that we were able to deliver on. Unfortunately, our primary energy cost went up, not only because we consumed more coal due to higher demand, but also because we used our open cycle gas turbines much more than we would have liked. This is a key cost driver for us, and improved generation performance will help us to bring that cost down considerably. We are continuing our maintenance program. We are resolute and not compromising on this, and it's a key focus area of the generation team to restore our plant to reliability. Unfortunately, though, we had major incidents at Medupi Unit 4, where we had a hydrogen explosion in our generator at that unit. It's scheduled to return in approximately 18 months' time. And then also we had a transformer fire at Kendall Unit number 1 that is scheduled to return to service on the 21st of December. We had 2 trips at Koeberg. We're not concerned about that. The plant is continuing to operate safely, and we intend to take the first unit out on a 155-day outage to replace steam generators. It's part of the life extension for the next 20 years of that plant, as well as to do a general plant outage. Once Unit 2, that's the first unit that's going out, returns to service, we will then take out Unit 1, and that unit will then follow for a very similar outage. The steam generators, very large pieces of equipment, have already been delivered on site and are safely housed at Koeberg. We reduced our coal inventory. This is in part due to the higher burn, but also due to better working capital management. But we are well within grid code requirements at all of our power stations. From a network perspective, we had only one incident on our transmission line that lasted 0.86 minutes, so we do take these things seriously. We measure it very tightly. But apart from that, both transmission and distribution performed admirably, and we want to thank our colleagues under the leadership of Sekemotso Skeppers and Monde Bala for their very hard work in maintaining stability across our grid and our network. Medupi 1 achieved commercial operation, so that unit, the entire plant, has now been handed over to the operations, and the contractors are no longer in control of those units, which means that we have achieved the objective that we've set for ourselves. The design defects that have plagued Medupi have been by and large addressed at our boilers. There are still further modifications required at our coal mills, but I must say it's very pleasing to see that the units at Medupi are now consistently performing at design specification, and that has made a major difference to the stability of our system. At Kusile, we have completed these mods at Unit 1. Unit 2 is currently on an outage, and then of course we will, for those units still under construction, implement these changes prior to starting commissioning. Speaking of Kusile, Unit 4 will be synchronized to the grid by January 22. Hopefully we can do it a little bit earlier. The team is working very hard on that. And then we aim for commercial operation, again, handing the unit over from the contractor to Eskom operators by June 22. And that will add another 700 odd megawatts to the grid, which is a very helpful addition to our generation capacity. We are required to install a flue gas desulfurization unit at Medupi. We have reached agreement with the World Bank to extend this timeline to June 2027, and we are engaged in pursuing this project. It is a large project. It will cost between 30 and 40 billion rand is the current capital cost estimate, but we are committed to meeting our environmental as well as our lender requirements in this regard. Lastly, another highlight, and this will come as a relief to residents of towns in eastern Mpumalanga that have had to bear the brunt of significantly increased truck traffic on the roads. We have repaired the coal tippler unit at Majuba. That has now been completed, and the first train was successfully offloaded early in October of 2021. We are working very closely with Transnet Freight Rail to increase the number of trains and further reduce the number of trucks on our roads in order to minimize damage to our road infrastructure and also to improve road safety and bring down the cost of coal transport. Next slide, please. From a triple bottom line perspective, We've seen this improvement in our particulate emissions, so that is very, very good. But some of our plants still reported poor performance, and that is something that needs to be addressed going forward due to poor coal quality. So increasingly we are focusing under the leadership of Sandile Siyaya on improving our coal quality, holding our coal suppliers to account, making sure that Eskom gets what Eskom pays for in terms of our coal. So a strong focus area to also make sure that there's no tampering with our coal in transit. And then internal plant performance, dust handling plants, SO3 plants, those need to receive more attention. We are still engaged in a criminal trial on emission contraventions at Kendal. That trial is set to continue in January 22. Our water consumption is not something that I'm pleased about. We know South Africa is a water-stressed country, and paying more attention to how efficiently we use our water resources is clearly a focus area. And as you can see there, many of our environmental contraventions are in fact related to water. From a people perspective, I referenced the fact that we were able to continue reducing our headcount. Our safety performance is good. However, it is appropriate at this moment to pause and reflect on the fact that 3 employees and 2 contractors lost their lives while in the service of Eskom, which of course is entirely unacceptable, and our heartfelt sympathy goes out to the families of the deceased. We are maintaining safety as our number 1 priority in Eskom, and we will not compromise on that. We are continuing to improve our racial and gender equity metrics. This is, of course, made even more difficult by the fact that we have a recruitment moratorium. So the fact that we are able to continuously improve on this score really speaks volumes for the commitment that we have as a management team to driving transformation at our professional and management level. However, we are less successful on a disability score, and this will be a key focus area going forward so that we can reflect the demographics of our society across all categories. We're continuing to provide electrification connections and then also drive preferential procurement spend, even as we focus on the elimination of non-value adding intermediaries from our supply chain. Next slide, please. Finally, in conclusion, let me touch on this key strategic imperative of legal separation. The target that we've got is to focus on the transmission business and set that up as an independent transmission system and market operator. We have achieved functional separation. We've got divisional boards in place. We've got financial statements. We've registered a new legal entity, the National Transmission Company South Africa. So that is in place. We have directors pro tem while we're in the process of compiling a short list of potential directors, which we will be submitting to the DPE for its final approval. We have completed a very extensive legal due diligence, more than 600 pages of legal due diligence work that was performed. And we have now put in place measures to start trading so that we can have the first electricity trading platform in place as soon as possible. And that is a very important sign of the commitment that we as Eskom have of steadily moving away from the monopoly position that we've occupied for close on 99 years now. We have in place an asset transfer agreement. This agreement is ready to be signed pending formal approval from the DPE as well as from National Treasury in terms of the Public Finance Management Act. Yesterday we received approval from DPE, so thank you very much to the Minister for signing that. And National Treasury, we believe, is in the pipeline. So as soon as we get those approvals, we can then sign the agreement, and then we will have a legally binding agreement to transfer assets from Eskom Holdings SOC into this wholly owned subsidiary. I may just say that this is one of the most complex corporate restructuring exercises that our advisors have worked on, and they're very highly skilled and experienced. And the fact that we were able to deliver to this point within the very aggressive timeline set in the DPE roadmap really speaks volumes for the very capable team led by Pindi Mabena, and I want to recognize her for the key driving role that she's played in enabling us to get to this point. So we expect to have this transmission company up and running during the 2022 calendar year. Hopefully we can pull that forward. But we still require a transmission license, first of all, to be cancelled. The transmission license currently is in the hands of Eskom Holdings, SOC, so that needs to be cancelled, and then a new license needs to be issued, and we are in discussions with both the Department of Mineral Resources and Energy as well as NERSA to put in our application for this new license. We are engaging with our lenders at 5 o'clock this afternoon to ensure that they are kept fully in the loop and on board with this. We have appointed a financial advisor as well as a legal advisor to assist us in this process, and we really appreciate the continued support from our lenders as we embark on this very significant restructuring process. There are certain amendments to the Electricity Regulation Act that need to be put in place. This is not a prerequisite for the legal separation, but it will facilitate the operation of a more liberalized market dispensation going forward. So therefore it is quite important that these amendments also get put through. So by and large, from an Eskom perspective, we have done everything that was at our disposal to meet the timeline of the 31st of December 2021 to achieve legal separation. And we really believe that this is going to be pivotal in addressing the generation capacity shortfall. So with that, I'm going to pause, and I'm going to allow my colleague Caleb Kassim to take you through the numbers in greater detail. Thank you very much.
Good afternoon, ladies and gentlemen and the media. Thanks for the opportunity. Okay, I think Andre said a lot, and effectively following on what Andre has said, this is the first time since I'm presenting that all the financial indicators, one, are moving in the right direction and are all green. However, this is definitely, although positive, it's not at the desired levels of where we want to be as Eskom to ensure financial sustainability, but I think it's a great step in the right direction. Obviously, as we all know, historically Eskom performs much better in the first 6 months and in the second 6 months. One, with the difference in tariffs when you compare winter tariffs to summer tariffs. Secondly, lower volumes and more maintenance. We then, from an Eskom perspective, financially perform much worse in the second half of the year compared to the first 6 months. And that is reflected in our projections as indicated, that loss of 9 billion by year end. But if you look at it, I think what is also important, looking at this slide here and looking at the last 5 years, this is the first time that we're reporting a profit as at the 6 months results. The last time this was achieved was in 2017. And even if you look at your gearing debt equity ratio, off the peak of September 2019, that debt equity and gearing is improving to levels that are getting towards our target for financial sustainability. Just to touch on a few key indicators, you see that the EBITDA margin compared to last year is up from 26% to 33.2%. And then in terms of your cash interest cover ratio, where you want that to be above 2, we're sitting at 2.2 compared to 1 last year. And in terms of your debt service cover, which includes your capital repayments, ideally you want that to be a minimum of 1. We were close to that for the 6 months at just 0.88, double that of the previous 6-month window. And then importantly, you see that your debt equity, including long-term provisions, at 1.59 compared to 2.52 for the previous year for 6 months ended September 2020, ultimately culminating in your gearing dropping from 72 to 61%. So that is positive, and then you'll see what the outlook is going forward. I think just to highlight from the restatement of these September 2020 numbers, you will recall that when we presented our year-end results, the one big change that we made was accounting for the pension fund from a defined contribution to a defined benefit. That then comes through in that restatement. I think also importantly, you'll see that the interim results that is uploaded, it hasn't been reviewed, as we were only able to appoint our auditors at the beginning of November. So this is based on management results. Unpacking the income statement in a bit more detail, I won't touch on the revenue. Andre's explained that. But the growth in primary energy substantially on the back of higher diesel that has come through. Just for the year-on-year movement, we've incurred another 2 billion rand worth of diesel costs. Over and above the coal purchase costs that Andre has spoken about. To run a coal power station, it's not just the rand per ton of coal that you pay for. There's coal handling costs, there's fuel, oil, etc. All those costs have to come into account, and that has escalated year on year, contributing to the 14% escalation in primary energy costs. And you will see in a later slide how we do unpack that, including a growth in IPP costs based on volume, as well as some costs coming through. From an operating cost perspective, our employee benefits is relatively flat year on year. The 16.4 billion growing to 16.8 billion in September 21. And under the O&M, what we do find that, number one, there's much more repairs and maintenance that has occurred in this first 6 months compared to the previous year. We will unpack that, in particular, some more maintenance in generation and distribution. And then following the 2 incidents that was highlighted, we had to then write off 900 million for Medupi Unit 4, as well as 86 million for Kendall Unit 1, ultimately culminating in that bottom line profit of 9.2 billion rand. And then you also find that your depreciation is increasing as more and more units are commissioned. We would then amortize those units. That comes through in your depreciation. But together with that, you will see later in the presentation, we then recognize more of previously pre-commissioning revenue and costs that flowed through, as well as more finance costs that will now be expensed compared to previous years being capitalized. If I move on. So in terms of your sales and revenue, it's very clear that all the sectors have improved except for your residential sector, slightly down 3% compared to year on year. and the big increases coming in the industrial sector and the mining sector on the back of better commodity prices that we've seen over the last year. I think importantly, the other item I'd like to highlight on this slide, you can see we still have our challenge from recognizing the revenue from, in particular, municipalities, and that trend in arrear debt is still increasing. So 5.5 billion rand worth of revenue we were unable to recognize as at September 21, and you can see that trend has deteriorated from the 4.6 billion of the previous year. And like I mentioned, on the positive side, as more and more units are brought into commercial operations, we then capitalize less of that revenue, with then that drop from the previous year of almost 1 billion rand coming through in terms of that revenue line. Unpacking our primary energy, so Andre's spoken about the 0.7% reduction in coal purchase cost. That does come through. However, the amount that you are seeing here is firstly total coal costs, which includes those other components that I've mentioned. And the other difference is this is the burn cost that hits your income statement rather than the purchase cost. So overall, we can see the rand per megawatt hour has increased year on year in total by 4%, but this is far lower than the previous historic trends of around 15%. This would not only bode well for this financial year, but that purchase cost reduction of 0.7% will filter into future outlooks in terms of coal costs and coal escalations going forward. I think the other item to touch on is your OCGTs. Other than the higher volumes that were incurred over this period compared to last year, we, based on the oil prices and that have escalated, we do see then that the OCGT unit rate has gone up 15% for Eskom plants and 13% for the IPP diesel plants, Avon and Dedisa. Renewable costs as an overall rand per megawatt decreasing by 10%. However, we do see that with the increase in production from the IPPs, as more and more bid windows have come on, together with the escalations, we've seen about close to 2 billion increase in IPP costs year on year. Overall, our primary energy rand per megawatt going up 5% compared to the previous September 2020. What are we doing in terms of, firstly, repairs and maintenance? And you can see that compared to September 2020, we've increased that to 8.8 billion as at September 21, with a 31% growth in generation and 20% in distribution. However, we do recognize in particular that generation requires much more in terms of the outage capex and the importance of releasing funds so they can plan adequately and timeously to address those capex requirements in terms of the outage commitments. Yes, based on the liquidity, we need to manage that. And as funding comes through, then from a finance perspective, we do release it. However, it's important that the earlier we can do that, it allows to create a platform for better execution on the generation side. Based on these results, we were able to increase that release for this financial year. Yes, it is a bit late. It should have been earlier. However, we've already released just over 8 billion for the next financial year. It's lower than the 10.7 billion rand that is required, but we believe that based on these financials, we are moving the right direction to also assist generation to address those issues. And you can see that on the capital expenditure, that escalation of 14.1 billion compared to last year this time of 10.8 billion. One would expect that at the peak of the build program, we would have incurred more capex for the 6 months, and as we come into the end of the build program, that capex then reduces as reflected in that trend analysis. It's also important to ensure that our capital projects are conducted in an efficient manner to extract the necessary savings as well. What we have also done as Eskom is, from a cost savings perspective and initiatives, it's not only that we want the results to improve by volume changes and tariffs. We focus on cost savings, including working capital, just to highlight that for the first 6 months we've achieved 7.8 billion rand worth of our savings target compared to 10 billion rand. We set a target of 20 billion rand for this financial year. Our projections as at the half year reflected a 18.5 billion savings by year end. Obviously would look to try to close that gap as Andre has indicated. I think importantly, other than looking at your operating costs, working capital, we don't want money tied up there unnecessary, and we're looking to optimize on the inventory side, on your maintenance and your consumable spares to release some of that liquidity back into the business. So over and above the positive drop of 15% in your debt from 463 billion rand to 392 billion, one, you can see that the liquidity position has improved year on year from just under 25 billion in September 2020 to 36 billion rand as at September 21. But important also to highlight, with the change in the exchange rate implications, we see that the derivatives that we hold has deteriorated from 36.8 billion to 14.6 billion. I think more importantly, you'll see it in the detailed set of financials. This is the first time in a number of years that our current assets actually exceed our current liabilities, again reflecting a positive trend in the right direction. In terms of our debt and what that mix is of the 392 billion rand, as at September, our local debt comprised 60% and foreign 40%. If we then move on to just looking at the finance costs and unpacking that a bit more, the gross finance charges 21.8 billion compared to 23 billion of the previous year. And then obviously you can see the amount that is capitalized, 4 billion compared to 6.8 billion of the previous year as further units are commissioned. Average borrowing cost year on year has remained relatively flat at around 9.85%, and our positive balance generates returns of 3.64% for the year. I think what is also important to highlight, that 21.8 billion rand is our second largest cost item behind coal costs. It's even higher than our employee benefits that was sitting at about just over 16 billion rand, and our capex that we've incurred for the 6 months at 14 billion rand. So as Eskom has always been saying that we need to address that debt stock on the balance sheet to a more acceptable level to create a more sustainable future for Eskom and to remove ourselves from being reliant on the fiscus for continuous support. From a funding perspective, for the financial year, we are looking to raise just under 42 billion for the year. As at September, we've had committed transactions in place of 16.6 billion rand. I think important just to highlight that syndicated loan of 15 billion, we've already secured 10 billion rand of that in October, increasing our funding execution, and we're confident that we will be able to achieve the remainder by March 2022. And next year's funding plan, we are looking at about 24.4 billion rand. We've already got committed facilities in place of 11.5 billion rand. From a government guarantee, what was available at the end of September, 47 billion rand of that. Obviously, 10 billion of that then was subsequently used with the syndicated loan since September. But importantly, you can see, based on our debt profile, the maturities are still significant. 71 billion for this financial year to March 22, and over the next 3 remaining years, those debt service commitments on average are around 60 billion rand per annum, and that's the importance that we need to address from a sustainability perspective. So from a cash flow, without repeating what I've said, the operating surplus of 36 billion absorbed by your interest repayments of 16 billion, your capex of 14 billion plus other expenses that give you your 21 billion. It does leave a gap after we've actually drawn down on the 16 billion rand, on 11 billion by September. And then we repaid the 24 billion. The gap was made up of your government support of 31.7 billion, culminating into our cash balance as at end of September. Your arrear debt, I think firstly on Soweto debt, you can see that has dropped from your March 7.5 billion to 6.9 billion as at end of September. We have written off some in duplum interest in terms of legislative requirements. However, of concern is our arrear municipal debts. That has increased some 16%, 5.6 billion rand since March 2021. Despite a number of interactions and the support and engagements with the political task team, the multidisciplinary revenue committee, we've entered and engaged with 45 municipalities around active partnering model, including all top 20 defaulting municipalities. Only Maluti Upper Fong did not want to agree to this partnering agreement. We're now addressing that through a court process. And of the arrear debts, the top 20 constitute 80% of your municipal arrear debts. In terms of other customers that are owing Eskom, there are 2 customers that owe Eskom in excess of 100 million, which totals 785 billion rand. So in terms of the outlook for the rest of this financial year, you can see, as we've indicated, and similarly to the last financial year, we moved from a break even to a 18.9 billion loss. So you can see in these numbers is about a 18 billion rand negative swing in the second half of the year, resulting in your EBITDA margin then dropping from the 6 months 33.2% to 21.6% forecast. Your operating profit then dropping from 29 billion to just about 22 billion. And then your interest cover ratio dropping from 2.2 to 1.5. Debt service from 0.88 to 0.69. And then even your debt equity ratio then increases again slightly to 1.8. What is also important, Eskom is able to continue to operate and sign off as a board of directors that we remain a going concern on the back of the commitments of the government support as per the medium-term budget speech by the minister, 21.9 billion for FY23 and another 21 billion rand for FY22. I think lastly, just to touch on, you would have seen in the media the MYPD5 rejection, Eskom's review and the court supporting that review. NERSA will now has published our application and will then hold public hearings in January to make a decision for the next financial year. I think it's also important to highlight to the audience that there is a Part B to that court case that will address the second and the third year as well. So importantly, yes, positive 6 months results, but there still are challenges. We all need to work and address not only the operational requirements, but more importantly, to address the financial sustainability, which from an Eskom perspective means delivering on our own cost base and cost efficiencies to deliver the 20 billion savings, for the tariffs to migrate to, as we've said, cost reflective levels. We need to address the municipal debt solution. Eskom cannot remain to be a bank to the municipalities. Just for the 6 months, 5 billion rand difference would make a big difference to our bottom line in terms of recognizing that. And last but not least, we need to address the balance sheet and what debt Eskom can sustain into the future. Thank you.
Thank you, Caleb. Thanks, Andre. Colleagues, thank you so much for your attention. I have to tell you that at 4:45, both Andre and Caleb have to leave to attend another call with the investors, bond investors. This is an obligation on their part. To address directly investors on a call, the bond investors. The Minister of Public Enterprises has also had to leave to attend to his other commitments. I can assure you, Heidi, that on January 27, 2022, Eskom will, in this same room, hold a media briefing in which we will expand on that particular announcement as we do on the state of the system.
Well, Eskom CEO earlier on, Andre de Ruyter, sharing his delight that units at Medupi are performing very well. Well, the power utility is projecting a net profit of 9.2 billion rand as financial results have improved vastly across all key profitability metrics, with sales volumes recording an 8% increase due to the easing of lockdown restrictions. Generation performance dropped as a result of load shedding. However, transmission and distribution network performance stabilized, and progress on new build programs and correcting new build defects was observed. Well, the power utility has just released its interim financial results. You're watching SA Today on SABC News. Thank you so much for joining us.